We're here. It's Wednesday. We're going to be having a schedule change soon. My calendar did not permit that. So this week. So I will make sure everybody knows. But welcome. If you're on the Zoom, appreciate you. We like to operate as much off of Facebook as possible just to eliminate distractions. But this is our Wealth Acceleration Office Hours. We changed the name from Q&A to Office Hours. Basically, we show up. We jam on the things that Dan and I share a lot of clients. We also have clients in completely different industries, which is awesome. And there's recurring concepts that come up. There's recurring struggles that come up. Dan and I probably talk for a total of maybe 3 hours a day if you combine it all.
Probably.
I was just reading the comments there. So what we do is we get together once a week. We talk about these concepts, these principles. Dan is always scamming and scheming on the next thing, staying ahead of the curve, staying ahead of trends like AI, staying ahead of all other conventional accounting firms and bringing these decision-making algorithms and helping distill them down and make them palatable. One of the things Dan does really well is his job, believe it or not. There becomes a limit to how many people, how many businesses Dan, and I'm the same way, can actually go into and do the thing. So a lot of what we do here is distilling it down, making it practical, pragmatic, putting it out there so that all of you listening can start implementing some of the things in your business. Sometimes like today, Dan has something distilled down enough to share it for the first time. We get a front row seat. And so what I encourage you to do is pay attention, ask questions as they come up. I'm going to bias the Zoom. So if you're here with us live in the Zoom, I'm going to be watching. I'm going to compiling the questions, making sure you get clarity at the end of it all. So that's how it operates, or that's how it works. We present a new concept. We share some examples, give some practical application tips. And then we're here to answer questions on what does it mean for you? How do you apply it to your business? If you got lost somewhere, it's a great opportunity. One, to get clarity, and two, to help us distill it down further so it is more palatable for all of you. So that being said, I hope you're on the Zoom. I will peek in the Facebook group. If anybody's creeping on there, watching, I'll make sure that we do get around your questions if time allows. But I'm excited for today because Dan has been teasing. He's been telling me he has this thing he's never shared before. And I think today he's going to share his principles, his method for cash flow engineering. And I think we all might think of cash flow engineering differently. So I'm going to let Dan kind of explain, similar to wealth, we all kind of define wealth differently. So Dan, what is cash flow engineering? How are we defining it here? And then I'll let you do your thing. You got a screen to share or whatever. We'll roll through it.
Yeah, I can pull up the outline at some point if that's valuable to everyone. Notes are going to be posted to the member site afterwards, and we've already built out some of the spreadsheets and everything to go along with this whole process. So as we get to that in the sequence, those things will also be posted to the member site for you to download and utilize. Because Alistair said that my mic was a bit quieter. Can you guys hear me better now? I'm not. Okay. Was that a thumbs up or was that a raise my volume?
That was a thumbs up. That
okay,
could
cool.
be confusing. Right. I understand.
I do like to mumble. I've been accused of that, and it's probably pretty accurate. I guess before we get into it, I'm wearing my best dinosaur shirt for everyone today. So, thought that was important to point out for really no reason other than I wanted to brag about the fact that I have a dinosaur shirt. Not really relevant to anything other than that. So, okay, what is cash flow engineering? So, when I think about cash flow engineering, I think about it in a few different frames. One is about systematically aligning your cash flows to your priorities. So, we talk a lot in this group, and I just talk a lot in general about the whole idea of what are your priorities and making sure that you've clearly defined those and you've ordered them from most important to least important, and that you've got some time horizon for when you're trying to achieve those. So you want to systematically align cash flows to our priorities. This is essentially another term that I would use is we're trying to rig the game, right? We're trying to get the outcomes that we want. So we're optimizing for our intended outcomes, really. So we don't want to maximize. First we optimize, then we maximize, right? So that's a principle that I've talked about at length in this group. So we need to know what we're optimizing for, which goes back to our priorities. Sometimes in the case of cash flow, we're optimizing for growth. In other instances, we might be optimizing for profit margin. So this isn't necessarily about having the most cash. It's about it's about engineering your cash to get the outcomes that you want. In some instances, that might mean the most cash now, but in other instances, not necessarily the case if we're optimizing for growth. Nick, does that make sense?
Yep. I think there's I'm sure you have something illustrating this, but I think it's important to realize that you have to know what game you're playing, because during growth mode, like profit margins will shrink potentially. And so just pointing that out, that it's not always the most cash on hand. It's funding the thing that matters or what's important right now.
That's right. Yeah, you may be making some investments into the business that are hopefully planned or are a result of the rule of 3 and 10, which we talked about last week, and I think I'll talk about a little bit more again today. But there may be some strategic investments. There may be some necessary investments based off anticipated breakpoints in the business. So that's going to impact your margin, but ultimately it should go back to what your intended outcomes are. And then in the process of going through cash flow engineering, we're also identifying some hidden assets. And I'm going to elaborate on that in probably in a future session about how you go about identifying these hidden assets. So what I didn't say in this process is anything about finance stuff. Is the reaction that a lot of folks have when I mention cash flow in general is like, oh, well, I hate finance, or I hate accounting. And the data is pretty overwhelming on this. 40% of business owners say the thing they hate the most about running their business is accounting. And just to sort of clarify, so and give some like high level definitions, and we could negotiate over whether or not these are all encompassing or appropriate. But when I think about finance, I think about management of money. When I think about accounting, I think about documenting what has happened. So when we're talking about cash flow engineering, this is more about strategy and execution. We need to know the numbers because that feeds into the strategy and execution, but it's not purely a financial or accounting exercise. Does that make sense? So that feeds into like, well, how often should you actually do this sort of thing, cash flow engineering? And I would say at least quarterly. How often are you assessing your business from the perspective of, are we hitting our priorities? Are we running optimally? So on and so forth. Hopefully you're doing that at least quarterly. Doing the exercise more frequently in terms of the deep dive that we're going to take you through the methodology, probably not a lot of value in doing the full analysis, just because there's not going to be enough material changes or data to have the necessary value to spend more time on it. So really you undertake this exercise on a quarterly basis. And then I'm a fan of cheesy acronyms. If you've heard me talk about the BIRD principle, business insight that's relevant and digestible, I'm always looking for cheesy acronyms. Maybe that goes back to and mnemonics. It goes back to the CPA exam for all of you who've been lucky enough to not have to study for the CPA exam. There are a lot of mnemonics that they use to help you memorize, because the test is really a memorization test. So I love acronyms and mnemonics, things like BIRD principle, business insight that's relevant and digestible. Came up with that with Steve Loudon, the Roku CFO. I have another kind of mnemonic for the framework for cash flow engineering, and that's CASE, C-A-S-E. We have to compile. That's really the more like accounting part of the exercise, is get all the data. Then we need to assess the data. Then we strategize, then we execute. So really each one of those steps is a kind of module or piece of this overall framework. And I'm big on frameworks for really, and principles, as you guys all know, but there's a reason for that. And it's not just because I like to listen to myself speak. Last week, or maybe it was the week before, we talked about financial readiness, this concept that your business has a biorhythm to it, and to some degree, and that you need to understand the rhythm of your business. What is peak season? What is the volatility that just inherently exists in your business because of the industry that you're in, and the way that you've constructed the cycles of the business, so on and so forth. There's a rhythm to it. And anytime you introduce something new, you're creating additional volatility in your business. And it becomes more difficult to assess or compare what has changed. So Nick and I were talking earlier today, just as an example, about sales and the number of units of a product that we sell called a roadmap. And I was sharing what we sold in January of last year, the number, and what we're on pace for currently. And in that explanation, we had to also describe, well, there's some volatility here because we shifted a few things. So in December of 2018, I punted because of capacity a bunch of meetings to January, and I handed off sales calls for myself to somebody on my team. And so that created volatility. So then this year, when I'm comparing the results, I have to adjust for the fact that volatility is kind of normalized. So we have to understand or evaluate when we've created new volatility in our business to actually do kind of an apples to apples comparison. So what does that have to do with frameworks? Well, if you're consistently using different methodologies to evaluate the same problem, you're introducing new volatility, right? And therefore we can't really problem solve as effectively because we end up with a lot of caveats. Well, you know, this is true, but remember we changed these 7 things. So, and then we ultimately can like let ourselves off the hook, or we just can't reach a definitive conclusion because we have so much volatility. So it's more obvious when you do a system change or you hire someone. It's less obvious if you're using a different mental methodology or different framework to evaluate the same problem. Does that make sense? Nick, anything you want to add to that or clarify? Is there some overlap here when you think about a lot of like fitness side of things, which is obviously one area of your expertise, where if you change your diet and then you're trying to compare results, or like, why do I not have as much strength when I'm in the gym? Well, you changed a few things. So we've got to be able to isolate for that.
Yeah, I think the notes, if you see me typing over here, I'm always taking notes for everybody on this call to refer back to. Using different methodologies to evaluate the same problem, right? And that's very, very common, and it makes it nearly impossible to establish a baseline and change one variable. And so fitness is a big one, right? Fitness is like, hey, I started exercising. I stopped lifting weights. I changed my diet. I'm drinking more water. I started going to bed at night, and my inflammation went down a little bit. Right? We have no idea which one of those variables, if it may be a combination, but we have no idea which one actually led to the result. So now we're married to all of those things, even if some of them may be counterproductive. We're married to them all. And so just things like that, we don't realize if we change too many things, we may get a positive result. But some of those things may actually be counterproductive. We cannot identify which ones. So there's stuff like that.
That's right. So we use these frameworks and these principles so that we're consistently using the same methodology so that we can actually do an apples to apples comparison of results today versus results in some comparable period. And we can hopefully draw some conclusions about what worked and what didn't work. So that's the importance of frameworks, principles, etc. With that, there are in terms of the overall cash flow engineering process, there are some lead principles that feed into to the methodology. And so I'm just going to kind of speak to these quickly because these are things that have been covered in previous Q&As, and I think that there's, for the most part, archive videos. If you want to watch an hour on this, we've got it in the member site or on the Facebook page. So rule of 3 and 10, that was really a lot of last week's conversation. The idea that anytime an area of your business triples or hits an order of magnitude of 10, everything breaks. So if you think about going from 1 employee to 3 employees, 3 employees to 10, 10 to 30, 30 to 100, so on and so forth, the systems, processes, et cetera, that you built for your employees and benefits and all that stuff probably is going to break at those points roughly. Same thing with clients, same thing with revenues. So there are these break points that can be anticipated. Now it's called the rule of 3 and 10. It's really a principle. So not necessarily is everything going to break at 3 or at 10 or at 30, but these are guideposts that we can refer to so we can anticipate. The value of that anticipation is that we're not going to overpay to fix something that's broken because we knew it was going to break, so we can plan for it. Also, we can be more intentional about the things that we're building. So if we know we're going to go from 1 to 10 in less than a year, let's build the thing for 10. Let's not build the thing, system, process, benefits, for 3. Because then we're going to pay to build something for 3, and then we're going to have to pay to redo it for 10. Hard costs, soft costs in terms of our time. So we want to use that both to predict things that are going to break so that we can plan for it, so we're not going to overpay to fix it. We also want to make sure we're being intentional about what we are building so that we've kind of right-sized the solutions to where we're at. So that's the rule of 3 and 10. The next principle that feeds in a lot to this is we always hedge our downside risk. At the end of the day, if you study most of the quote unquote great entrepreneurs, or the folks who've accumulated massive sums of wealth, the thing that on the surface, it appears that they're very risk tolerant and they got lucky and things just happened to pay off. But as you study it more closely, you often find that what they did is they created asymmetric risk. Asymmetric risk is where the upside is substantially greater than the downside. And sometimes that's because you found an opportunity that you can exploit, or arbitrage. Basically, it's a scenario where inherently the upside is greater than the downside. These are like the unicorn opportunities, and often the things that are most fantasized about in like business literature are these unicorn opportunities. But oftentimes that's not the case, that inherently the upside is greater than the downside. So we need to go through this exercise, though, of identifying what our downside risks are so that we can eliminate them. And to the extent to which we cannot eliminate them, we have to ask the question, if this risk, this downside thing were to occur, would it be fatal to our business? Or would it be so materially impactful that it would be hard for us to recover? So we need to identify those risks, hedge them. Next thing is that we're going to make decisions based off what we know today, not speculation. Back to optimize versus maximize. You can speculate if you have sufficient data, and that in the data you can isolate what is correlative versus what is causation. Again, we've talked about this quite a bit, but if you don't have clear insights into the data that you're using to speculate, you're taking on a disproportionate amount of risk. We go back to, are we hedging downside? So correlative is positive or negative. If something happens, then generally speaking, we can expect an outcome from that, but it's not causing the outcome. Ideally, we want to find causation situations where we know, for example, if I punch you in the face and it hurts, you know that me punching you hurt. That's a causation. If I'm walking down the street and I'm looking at my phone and something around me happens, somebody else trips or walks into me, that maybe that's another causation type scenario. But it could be correlative in the sense that maybe a bunch of other factors happen to be related to me looking at my phone. Nick, you might be able to come up with a better example than that between correlation and causation. I usually talk about this sort of online banking thing that I've chatted about in the past, but I won't go down that rabbit hole. The next big thing, and I have not talked about this much in the group here explicitly, but when we're analyzing our cash flows, never discount the cost of cognitive burden.
Well, that's a huge one.
Never discount the cost of cognitive burden or cognitive load. So again, often we're a team of one or a team of few, and we aren't a big corporation that has huge teams of resources that are all handling individual like line items on a P&L. And so when we're doing our analyses around cash flow and all these sort of things, are we taking into account the cost of us having to think about this? So let me give you an example that comes up regularly in my business, which is tax payments. So it is factually correct that you can make quarterly tax payments, and as long as you follow a specific framework, you're going to be free of any penalties and interest. It's also true that you can strategically plan and pay the minimum amount without penalties and interest, and pay the remainder on April 15th, the tax deadline, or March 15th, April 15th, simplify. And so that's factually true, that there's a way that you can save your money and pay on these quarterly payments, maybe draw some interest, and then you pay whatever's remaining on April 15th. Well, what I know from thousands of interactions over the years is that people get pissed every time they make a tax payment. And even though it was knowable, and in many cases known, and that they intentionally opted into, I want to pay the least during these quarterly payments to avoid penalties and interest, and I'm gonna pay the rest on April 15th because I want to hang on to my money longer. It's this known thing. They opted into it, and then when they write the checks, they're pissed, and they're not just pissed for like 30 seconds or a minute. They're pissed off usually for like 7 to 10 days, and it's impacting their decision making. And the things that I hear from them are, why am I working so hard when I have to give up all this money to the government? And I have enough data to say that doesn't matter what political leanings you have, the most conservative, most liberal, everyone is experiencing this. I'm a tax person. I get pissed off about it. And so these are, you could opt for this option where you're maximizing your interest income, but at what cognitive burden? How much is that going to cost you in terms of your ability to execute for the 7 to 10 days after you pay this? And would it be better for you to come up with an automated solution so that you don't really have to think about it? And so the answer is, it depends on the person and where they're at, but more to illustrate the point that there's a cognitive burden cost to you. It's a soft cost of being pissed off, and maybe that impacts your sales or something. That would be a correlation example. There's some correlation to you being pissed off and your ability to execute on a bunch of different decisions. So we got to take into account the cognitive burden. And then the last principle is that we always preferenced T-learning over I-learning. And this is really going to come into play when we talk heavily about how we go about identifying hidden assets within our business. And so I-learning is basically drilling down on a specific industry. So accounting, I want to learn everything I can about accounting, the industry, how firms operate, what all the best practices are, so on and so forth. And T-learning is this idea that we can pull from any industry and natural law, and then we can apply it. So then we can apply it to the industry, in this case, accounting. And so the approach of I-learning is how you become a domain expert, right? And there is importance to depth, and this is the whole like 10,000 hours thing about how long does it take for you to become an expert. So there's an importance in having the depth to be able to solve problems. The downside is that 10,000 hours takes a long time to get there. And so we often already have the answers to problems if we could just look outside of that specific domain. So an example of that would be that I've spoken about this a little bit in the past, but an example of that could be client onboarding. And this is something that Nick is particularly exceptional about, and what you get if you go to one of his office days is really taking the domain and then pulling from a broader base. So onboarding, I could go out and try to talk to every accounting firm and find out what is the best way to do onboarding, and find out what they're doing. Now, the problem with that is that is it the best way to do it based off the way my business is structured, or is it simply just the best out there for accounting firms? So my business has unique aspects to it that are different than other firms. And so do I end up with a solution that's not actually customized to my problem, but I end up with like the best practice? So alternatively, applying more of a T-learning approach, you could go, who is the best at onboarding? Southwest Airlines, maybe. And so what about their methodology approach is so effective? What can I learn from that and apply it to my business? Or in natural law, under natural order, what is onboarding the most comparable to? You could dating. So what would you want to do when you first start dating someone to make sure that it's going to be effective, right? And so you can take these things that are already knowable and known by you, and those learnings, and then apply it to your specific problem. So we want to apply T-learning or bias T-learning over I-learning, because it's more efficient and effective. We still need to be a domain expert to be able to offer superior technical service, but we're not limited to our domain to solve specific problems. So these are lead principles, and as we walk through the application of actually doing the cash flow engineering, I'll tie back the principles to the ways that I go about analyzing the financials. Anybody have any questions? If so, you're always welcome. Drop it in here. Nick's monitoring them. I'm taking a look at them as well. So drop in any questions, comments that you have as we go. So with that, I want to do some macro level application of the principles. And at the highest level, when we talk about cash flows, we got revenues, stuff coming in, and we got expenses, things going out. So first off, when we think about our revenues or our cash that's coming in the door, is it predictable? So that's the first problem that we need to solve and analyze is, do we have a predictable stream of revenue? And I look at a lot of these because ultimately we're ultimately trying to systematically align our cash flows to our priorities. And there's this equation, which is this idea that financial anxiety equals financial uncertainty times financial powerlessness. And so uncertainty, another, I guess, word for uncertainty, if things were unpredictable or volatile, you would likely have uncertainty. And so we want to drive our uncertainty down as close to zero as possible. Now, the problem is that inherently uncertainty can never be zero, because there are external factors, things that are outside of our control, things like the economy, what our competitors might do, what our employees might do. It's a whole list of things that we can't necessarily control entirely, but we want to drive uncertainty as close to zero as possible. The power side, so financial anxiety equals financial uncertainty times financial powerlessness. That power side of things is what we really can control, right? Through systems, processes, methodologies, these principles, the things that we talk about in this group. So we want revenues to be as predictable as possible. So this goes back to really the ability to hedge downside risk. So if revenues are really unpredictable, then we've got a lot of risks that we can't hedge. And then we want to be able to make decisions based off what we know today. And if we don't know when we're going to get paid, makes it really difficult to make decisions. And then we've got the whole cognitive burden aspect, which is having to chase people down is really stressful. So when we examine our revenues, are we paid in advance or as you go? We don't want to be paid upon completion to the extent to which we can minimize that. At least not more than 20%. So the extent to which we are being paid upon completion, we're introducing a fair amount of unpredictable nature to our revenue cycles. So how can we get paid in advance or as you go in clearly defined milestones? Part of that is understanding the difference between services and a product. So if you deliver a service, you effectively have zero collateral. You share the IP. So right now I'm sharing this information. If you hadn't paid in advance, I can't get that information extracted from your brain after the fact. You already got it. It's already done. Whereas a product, you just go, I'm not going to ship you it until you pay it. So you've got a little bit more leverage. So we got to understand the difference there and ultimately engineer our revenue cycle to ensure that we're getting paid in advance or as we go with clear milestones such that we've aligned our expenses with our revenues. So ideally our expense cycle and when we're paying out bills is the same cycle as when we get paid. And that sounds really simple. And maybe a lot of you are going like, oh yeah, that's a no-brainer, I'm already doing that. I find that that's not the case for most businesses when we start going through the timing of when they're paying bills versus the timing of when they're getting paid. Maybe 50% matches up, but there's this other 50% that doesn't. And there's an immense amount of volatility that exists because of that. So we want our full expense cycle to be aligned with revenues. So if you have a disproportionate amount of revenues in the first quarter, then your expenses should align with that. Now, for some folks, they try to use this busy season, this first quarter of the year, to finance the rest of the year, right? Where it's like, I know I'm going to bring in a lot of money in Q1, but I need to save and allocate that money for the rest of the year. Okay. This is a huge amount of cognitive burden there. Do you have the team resources in place to actually effectively manage that? There's going to be a cost, not just the emotional burden, but a cost of resources to make sure that you have all of the boundaries in place so that you are able to effectively spend that nest egg. Ideally, we're eliminating that. So that means that like in Q1 for me, which is one of the 2 busiest quarters of the year, that's when I'm going to be paying out, I'm willing to make investments during that period because I want to align the expense or cash outflow with revenues. Also, we need to be able to eliminate accounts receivable, which means that we're controlling the timing of when we get paid. And long game is to get people on ACH. So biasing ACH over credit card. This conflicts with a lot of what the sales coaching folks out there will do, which is like get the cash as quickly as possible. So let's get a credit card right now for that payment. If it's a one-time thing, sure. But if this is going to be an ongoing relationship with clients, we want to bias ACH over credit cards for 2 reasons. One, it just costs a lot less, close to 3% for credit cards. ACH is, typically less than $1 per transaction. These are fixed fees. And so ACH is where you're getting their routing number and their bank account through some encrypted process, usually where you can't actually view all of it. The reason why we're going to bias not the ACH over credit card, not just because the fee savings, which is massive, but this other reason, which is that someone can cancel their credit card and then you don't get paid. But to cancel their ACH transactions, they would have to go and take an extreme action, which is call their bank and put a hold on their account and say, don't allow this company to process against my bank. That requires kind of more extreme action. I've seen that rarely done. But if they don't do that, they'd have to literally close their bank account or have insufficient fees or insufficient balance to pay you. But you just have substantially more control over the funds. It's easy for somebody to cancel their credit card and for them to call their credit card company and request a refund. So chargebacks don't really exist with ACH. The window for chargebacks is like 5 days after when the payment is processed for you to challenge, whereas effectively the liability on credit cards is seemingly unlimited because there's different fraud protection and just different banking rules around ACH versus credit cards. So very difficult to appeal and have an ACH charge reversed. Very easy for someone to appeal credit card charges. So I bias ACH over credit card. Anybody, almost universally with a few exceptions, I think 98% of our clients pay ongoing fees via ACH. And that's just because we're looking for the certainty and of course the savings. So we're controlling the timing. We want that information so that as we're completing the work, we're able to process payments rather than someone paying us or, my credit card expired and now I need to reach out to them and get that updated information. The ACH information doesn't expire. And again, unless they change their bank, which is a whole pain for people to do that. So it doesn't happen very often. So these are macro level things that we look at first. So we're analyzing revenues and we go through, are all of our revenue streams predictable? Are we getting paid in advance or at a minimum as we go with clear milestones? When we're offering a service, we especially need to bias paying in advance, given the fact there's no collateral. So as we deliver the IP, we can't get it back. And then we need to be able to control the timing, which is we need some payment information and in particular ACH so that we don't have the risk of the chargebacks and all the fees associated with that, and much more difficult for them to stop payment because they're pissed off. Again, no collateral if you're a service provider. So a lot of the online businesses I know have huge issues with chargebacks and having a massive amount of uncertainty as a result. Nick, any questions on that?
No, that makes sense. I'm just working through the lead principles and, the understanding that biasing reliability, something I talk about all the time is start biasing reliability. Yeah. It's just the biasing ACH, which also eliminates that cognitive burden of chargebacks. It's just
So before we can really do an accurate or sufficient analysis, we want to make sure that we've got these kind of macro level principles kind of locked in so that we're minimizing the amount of uncertainty. Then at the high level on the expense side, whenever I'm incurring an expense, part of the question that I go through is this something new? Is this a new vendor or is this a new expense? Nick knows this. Anytime it's something new, especially a new vendor, unless it's transactional, like a SaaS, I always ask for a payment plan every time. Even if the cost is 10, 15% more, I'm always asking for a payment plan with an option to pay it off because I'm hedging downside risk and I'm creating leverage in the relationship, in the sense that they have more of an incentive to deliver, and I have more of a carrot in the sense that if the services aren't delivered, I haven't paid everything up front. So this is a little bit contradictory, because on the revenue side, I'm pushing for getting paid in advance and ensuring that if it's a service in particular, because of no collateral, I want to lock that in and get the certainty. On the expense side, I'm doing the opposite, and I'm knowingly being a hypocrite on this, which is that I don't know you yet, vendor, or this is a new expense, and the risk is that we start working together, and you just don't deliver the product or the service, and or there's a bunch of bold predictions, and I've got to like chase you down, and I've already paid you, so what's your incentive to deliver? So it's okay to be duplicit, because these are separate elements of your business to some degree. And so we're knowingly being duplicit in the way that we handle our expenses. We're pushing for payment plans for new vendors and for new expenses. Once you've built the trust and they've consistently delivered results, then you can start paying up front. We need to limit the downside risk here, that they just simply don't deliver. If it's not a new expense, then we've got a whole strategy for how we go about assessing what to do with those expenses and how to overall optimize them. And so that's a kind of a separate module. Ultimately, we're correlating our expense cycle to our revenue cycle as much as we possibly can. So those are the kind of macro concepts that we need to assess before we move into really compiling the data. We need to get all the data in one spot before we assess, and then strategize, and then execute.
Awesome.
So I can tease the spreadsheet now. I don't know that we have enough time to go through it, but I can show kind of the next step to get people thinking. Nick, if you think we've got time on that.
Yeah, why don't you tease it real quick, and then we got some questions. Okay. And all I think about is I don't know if people know this, but your thing is rig the game, right? If you were to one day launch a podcast, it would probably be called Rig the Game. And that's what I'm thinking, is just rigging the game to create the asymmetry, right? So being duplicit in the two areas, I don't think is inappropriate.
Yeah, you're opting into it.
Yeah.
So back to kind of the whole, we need a framework. So we're intentionally opting into, this is the way that we're going to approach revenues. This is the way that we're going to approach expenses. They don't need to be the same. We just need to consistently apply that as we proceed.
Brilliant.
Okay. Do you see the?
Yeah, I can see it.
Okay. So we've got this initial tab, and this is just example data. Where ultimately we're going to get every one of our expenses listed, what the amount is. So this is compilation, stage one. We got to compile the data. This is really the accounting piece. The stuff that folks in particular hate. This is often where people stop, because it's just like, I don't want to compile the data. I don't like finance and accounting stuff. We just need the data so we can do the assessment and the strategy and the execution, which is the real business stuff. Again, accounting is just the output of whatever you decide. Finance is just managing your money. And if you're managing it, it should be managed in a way that's systematically funding your priorities. What's the point otherwise? So we get all of our expenses in, we get the amount, we get the frequency. Is it one time? Is it monthly? Is it bi-monthly? In this case, every other month, quarterly, annual. And then we determine, is it fixed, variable, or step cost? And I'm going to explain all this stuff in the next session. And then we need to assign it to a segment of the business and assess the longevity. How long have we had this expense? These two pieces are start to feed into my more unique approach to how to do cash flow engineering. Because we go over here to our segment data, and so we've got product A, product B, cost of goods sold related to product A. So what are all the segments of our business? Marketing, HR, you could have accounting. And then what is the nature of this segment? Is it primarily relational or transactional? And where are we at? Are we approaching the 3 and 10 for that specific segment? Okay, so is this primarily relational or transactional? Where are we at in the 3 and 10? And so we get all these expenses, we map them to the segment and the longevity. So effectively we've identified this expense is related to product A, and over here in product A, we've said that this is relational, and we're at the 3 and 10 mark, and that we've had this expense for more than a year. So we're going to compile all of this, and like I said, next week I'll explain more what fixed versus variable versus step represents, how to determine what segments you have in your business. Longevity is more stands on its own, and I'll explain what relational and transactional means. Because once we get this data, then we assess, and then what does it all mean to us as a business? And then that's when we move into the actual strategizing. That's the phase where we're actually systematically aligning our cash flow. And this is what's going to give us the information to identify our hidden assets. So I'll give you the actual tips and tricks to really leverage all of this. But maybe I can give you a few examples right now to tease, or one example to tease. So say that I've got vendor 1, and that's Nic Peterson, and I pay him I'm just a large sum of money. In this
$4 million a month.
$4 million. And that's monthly. And this is a fixed cost, and this is associated with marketing. And we've been in a relationship for more than a year. And marketing is a relational part of our business. And yeah, I think it's about to break. So I'm paying this huge sum of money to Nic. So how do I now go about aligning this with my priorities? So I'd have to line out what those are, right? And so in this methodology, what I'm going to do is identify, how can I fund this? How can I create a stream of revenue that funds this cost independent of what I already have going on? So what already exists where I can create a stream of revenue that's going to fund this cost in a way that's going to be mutually beneficial, because we've had a relationship for more than a year, and because this is relational, this isn't transactional. If it were Microsoft, it would be transactional, right? I can't really go to Microsoft necessarily in my current situation and rig the game on this expense because it's transactional. So we systematically start identifying existing opportunities in our business that can fund these expenses, right? And or adjust the way and timing of when this is paid to align with the timing, the revenue cycle of our business. So if I'm paying $4 million a month to Nic right now, well, I have a peak time of year, right? Q1 and Q3 for my business. So I'm going to re-engineer when this expense is paid to be quarterly and in alignment with when I have these large chunks of money. So that's just a really high level thought process. We'll give you more specifics on how to go through and actually compile and tie this all back to your priorities, and basically identify these pockets of additional cash and ways to effectively reduce the cognitive burden that exists throughout the year because of the misalignment in timing of things. Nic, it looks like maybe you had a question there.
Nope, I was gonna answer Tasha's question or bring that up whenever you finish. So
okay.
It's all. I think this is missing in the internet world by and large. And I kind of think it's just a byproduct of not expecting to actually keep their clients around for long. So there's not a lot of planning that has to go on.
Mm.
But Tasha said, real quick, would you recommend ACH for one time or only ongoing? My guess is it depends. I'll tell you what I bias, Tasha, just to give you, because Dan's answer might be different. I bias lowest possible headache. The ratio of money to headache, I want to improve all the time. And so for me, it's so easy to send a payment link for one-time payment that collecting ACH is kind of a headache. So a one-time payment, I would send a payment link. Preference, just a personal preference. Anything that is ongoing, probably more than 2 or 3 payments, I would do the little bit of headache right now to avoid all that headache later on, if that makes sense.
So I have a incrementally different approach. So we use a platform called Practice Ignition, and it allows us to pretty quickly toggle between ACH and credit card. And so we can get both options or just one option. And so during times that are really peak season, where I know that cash is plentiful, I will, for a one-time new engagement, I will always send the proposal as ACH only, and then give the client the opportunity to respond, or prospect to respond, like, hey, is there any chance you do credit card? And what I find is 80% just do the ACH, because through this platform, all they do is they sign into their bank account, and they select the account, and it authenticates everything. So they don't have to know their bank account number and routing number. There's a login where they basically use their credentials, sign in. It doesn't store any of that for us. So it doesn't take them much longer to enter in ACH than it does credit card, because that tends to be the biggest barrier. If someone's got to go look up their routing number and bank account number, that will take a lot longer. So I'll start with ACH and see if they push for credit card. And if they ask for credit card, then I'll say, yeah, that's fine. For one-time projects, we'll allow for credit card. For ongoing, we prefer ACH. That allows us to keep our fees down, and people go, oh yeah, that makes sense. And some folks will say, actually, I need to do it on credit card because X, Y, Z, right? And so then we'll make a case-by-case exception. But like I said, 98% of the time, people just do the ACH. In the slower months, the kind of off-cycle, non-peak season, then I will just give people credit card and ACH option at the same time, because I'm preferencing speed in that case. Like, I want you to sign and enter as quickly as possible, and I need to cut down on the possibility that the ACH is going to be a deterrent.
Yep.
So that's my approach. If people don't sign right away, when just ACH is marked, we're reaching out to them anyways. So they're getting opportunities to tell us that ACH is a pain. So
awesome.
That's the way we approach that. James had asked, break down my expenses by category and not particular vendor often. Can I use this approach on the category by category basis instead? It's going to, the short answer is partially. You can in areas that are transactional. You can group them by category. But things that are relational, you'll want to break it down, because those are the areas that you have an opportunity to explore or exploit, to use Nic's vernacular.
Cool. So that's hopefully that's helpful. We're gonna deep dive. If there seems like there's a ton of maybe more granular things that you have questions on, make sure you show up live, because I've seen the outline. We're just kind of scratching the surface here, big picture overview. So show up. If you want to invite anybody, you want to share it with them, wealthqa.com, wealthqa.com. And if you want to look like a really good friend and give them a little bit of a discount, they can enter coupon code LETTER, all in caps. All caps, I'm going to leave that there until we decide it's expired. So, but the more questions we get, the more mental reps everybody else gets. Every time James asks a question or Tasha asks a question and we hear the answer, we take mental reps. I call it collective momentum. So even the people that are already here, encourage them to come on. They may ask the thing that you don't know to ask or that you are afraid to ask.
Yeah.
Big benefit in that. And Dan, are we doing same day and time next week?
I think so.
Cool. Same day and time next week. So I will make sure that this replay is available in the member area, along with the notes that I took.
Cool.
And then we'll share Dan's outlines in the future trainings.
Right on. All right. Thanks, everyone. And yeah, we'll see you next week.
Okay, bye.